would like to present about the accounting treatment of all palm trees and fresh fruit bunches or RFB. All palm trees are classified as bearer plant under MFRS 116 because they are used to produce the biological product over many years. Therefore, they are measured at cost less to accumulated depreciation. In contrast, FFB are biological assets under MFRS 141 and are measured at fair value less cost to seed. For the second one is the CFO value the immediate FFB using the full market price of harvested FFB, resulting in 6.5 billion fair value gain. This does not achieve faithful representation because it ignores the biological risk and uncertainty. As a result, the characteristic of neutrality, completeness, and freedom from errors are compromised. The economic sustain of immediate FFB is different from the harvested FFB because they have not yet matured. Therefore, using the full harvested market price may overstate the assets and the profits.
My name is Zulaika binti Bari and my matrix number is 309354. For B, C, a more faithful valuation approach should consider the maturity level of the FFB and the risks that involve, such as weather condition and uncertainty in future yield. This would provide a more realistic value and better represent the actual condition of the biological assets. For C, A, following the CFO's instruction, create ethical risk because it may compromise the integrity and objectivity, and it could mislead investors by overstating the assets and profits. For C, B, I should first review the MFRS 141 and gather supporting evidence. If my concerns are not addressed by the CFO, I should report the matter to the higher management or the audit committee. For C, I have a responsibility not only to my employer but also to the investor and other users of the financial statement. Therefore, I must ensure that the information reported is accurate, reliable, and complies with the accounting standard.
I'm going to explain and classify the three properties under the prime development Berhad. So for property 1, since the floor can be split and sold separately, we need to classify it separately. So the 7 rental floor will go under the MFRS 140 inventories property, while the 3 HQ floors will fall under the MFRS 116 PPE. Next, the property 2, because the future use of the land is undecided, so it will go under the MFRS 140 investment property and held for the capital appreciation. Lastly, for the property 3, since it's under active construction and to be sold in the ordinary course of business, therefore it will classify as the MFRS 102 inventories. So that's all for me. Thank you.
Now I will explain for question B. For initial measurement, all property are measured at cost. Meanwhile, for subsequent measurement for property 1, it use fair value model or cost model. For property 2, it use fair value, which means that the gain or loss will record at the profit or loss. For property 3, it will be recorded at the net realizable value, which is an RV. So the CFO proposal is violate the faithful representation because according to the conceptual framework, financial information must be provide a faithful representation that require complete, natural, and free from error. If we look at the property 1, it contains investment property and PPE, but it is classifying the entire building as investment property. For property 3, it's supposed to be qualified as inventory because it is being developed for sale in the ordinary course of business, but it is qualified as investment property. So if all these are under investment property, it will overstate the investment property balance and mislead the investor regarding the nature of assets. So this shows that the CFO is lack of nationality and potential earning management because the CFO wants to make the reported profit and the total asset looks higher and present stronger financial positions.
Next, we will discuss the accounting treatment for the food manufacturing division under MFRS 137, provision, contingent liabilities, and contingent asset. First, for question A, should we recognize a provision for product recall costs? The answer is yes. A provision must be recognized. There is a present obligation from a past event that the contamination and subsequent public recall announcement. An outflow of resources is probable, with management estimating a 70% return rate. The cost can also be reliably estimated, with 1 million being the most likely amount. For a consumer lawsuit, the answer is no. A provision should not be recognized. Instead, it must be disclosed as a contingent liability. This is because losing the case is not probable. The legal advisors state there is only a 30% chance of losing. Since the probability is below 50%, it does not meet the recognition criteria but must be disclosed in the notes to the financial statement because the risk is not removed.
Moving on to question B. Uncertainty plays an important role in determining whether an item should be recognized as a provision or disclosed as a contingent liability under MFRS 137. For the product recall, there is uncertainty regarding to the exact amount of cost that will be incurred. However, because an outflow of economic benefits is considered probable and the amount can be estimated reliably, a provision is recognized using the best estimates, which is RN 1 million. For the consumer lawsuit, the uncertainty relates to whether the company will actually be required to make a payment. Since the legal advisor estimates only a 30% chance of losing the case, the outflow is considered possible. Therefore, no provision is recognized and the lawsuit is disclosed as a contingent liability instead. In conclusion, MFRS 137 requires companies to consider the level of uncertainty when deciding whether to recognize a provision or disclose a contingent liability. This ensures that liabilities are not overstated while still providing relevant information to users of financial statements, resulting in a fair and faithful representation of the company's financial position. Thank you.